my first question actually is like, we went through this report. You guys are from that particular industry. I want to ask you, like, was there anything surprising in the report that, Vikas was talking about it? Like, I'm sure you must have found something interesting out there that, in spite of being in that space, you must have gone, oh, wow, I was not aware about that. Can you talk about that?
Yeah, sure. I think one of the things that I was a little surprised about was the mix of asset classes and how that's shaping up. I mean, I would have thought that while the alternates definitely would have a large percentage of holdings, but to look at it as almost half of the portfolio was a bit of a surprise, because I would have thought that, especially in the Indian context, equity on the public market side is still held in a big way, and fixed income as well, because of the conservative profile of some family offices. But to look at 50% in alternates, that was quite a surprise.
There is a lot of excitement about startups, and at a time when startups, especially we have seen that over the last 2 years, the valuations have actually gone down. So I would just like to ask you, how do you kind of look at it? Like, we have seen like some of the biggest startups, including, if I can name some, like by Jude and all, like they were like, we have seen that the valuations are going down. So how do you guys? Why is there so much interest in startups at this point in time? Is it like value investing or something like that?
A lot of the family offices, by the very definition of family, have been promoters, are promoters, and so they are very habituated to take business risks, right, as opposed to investment risks. So, and in most family offices, I think Sachin and Nilang referred to the report that 13% of the family offices which were surveyed, have large teams, which means they are the very few who fit into the manager model, and the majority of them fit into the allocator model. So in an allocator model, the patriarch often decides, what the strategy of that investment or pool or surplus is. So because they are habituated to taking business risk, but they know the business. So effectively for them, it is not so much of an allocation, but it is saying a majority of my money I will put in businesses that I know how to grow and I can add real value. And then whatever is left, let me go around and see, what can be done, and which manager, which strategy, how much, etc., etc. So it's often a trickle down, and the primary motive is really the personality of the patriarch of that family office or family or pool of capital.
Since I cover mutual funds, so there are very few fund managers who would actually look at small cap, mid cap, and large cap. My specification is only large cap. But here, when I talk to you, like here, there is nothing like that. You have to do everything from startup to large cap, small cap. It doesn't matter. Can you just kind of tell me, like in terms of like when you're building your investment philosophy, how do you kind of like build your entire concepts of risk and return ideas? Like how is it like means like before you invest, how do you kind of state it, and how do you kind of go on building it?
So, okay, I'll add to it. So there are two types of family offices. One which will have an active business, like Hero Motor Corp would have has an active business, and there are certain like ours which has a complete exit, which have completely exited the business. So both families will have a different way of looking at the investments. A family business which has a active business going on will have cash coming in every year. So they will play differently, whereas our family offices do not have an active business. So I will play differently. I will not allocate much to unlisted assets because it's illiquid. I cannot sell it easily. I'll have a very small portion towards alternates, maybe 20% or 15%, and the rest will be debt or debt substitutes and then equity. Whereas a family office with an active business will have continuous cash flow every year towards the family office, and they can allocate larger amount of money towards alternate assets. And then obviously you build an IPS depending on how much cash flow you need every year to fulfill your expenses. For example, we have a small 20% towards debt, 20-25%, which takes care of all the expenses of running the family business as well as family expenses. So we look at it in a very different way than an active family business. So that's how it works.
Actually, there people have made a lot of money, but they may not be big. Like they may not be having a corpus of like not even 500 crores. Say, let's say people who have say 100 crore or something like that, they may not be in a position to kind of build an exclusive family office. Do you think, how do you look at the future of the business actually?
So it's a combination of multiple portfolios. So, there is an allocation to mutual funds, there is allocation to PMS, and then there is a direct equity portfolio where I am the fund manager for that portfolio. And most of it is data driven, so there are benchmarks for everybody. So there is a benchmark for mutual fund, and then let's see how are funds performing versus the benchmark for PMSs. And the direct portfolio is to be benchmarked with those other two asset categories. So again, whichever is performing better, you reduce the allocation of the underperformer and increase the somebody who's outperforming. And that can happen in bits and pieces, and over a period of time, you will know what has worked for you. So for our journey, the direct portfolio has outperformed significantly over the last 4 years. So, we have only seen funds going more and more into the direct portfolio because that has worked. Maybe tomorrow it might not work, and that shift can again go back to the other asset classes that are working. So a lot of decision can be taken back by data, and a lot of this data is easily available.